Okay, just to review, this is the same notation that we used earlier. So we used ST to indicate the spot price of the underlying asset today. So small t is today, capital T is the day of the expiration. F small t is the forward price today, or forward price of new contract that is created today. Sometimes we use it to refer to futures price, but for now, let's say again, forward. Capital T is delivery date. Therefore, capital T minus small t is the time to delivery, time to maturity. And we count all this time variable in terms of year. So if it's 6-month contract, capital T minus small t would be 0.5. If we are talking about 3-month contract, then capital T minus small t would be 0.25. If we are talking about 1-month contract, then capital T minus small t would be 1/12, things like that. So we are counting years. And interest rate, which may change over time. So if necessary, we will add time subscript. But in simple example, we'll assume that the interest rate is constant. So then we don't need to use time subscript. And anyway, unless there is some other specific notes, we are thinking of annualized log rates as in the previous example. And spot price at time capital T is S capital T. So these are the notation that we will use. We'll start with the idea of equilibrium, and we will make some comparison between a few different possibilities. So now let's start from the investing in the spot market. So if you buy something in the spot market and you pay S small t now, and you wait until time capital T, if there is dividend income and storage cost, you will get paid some extra. So you will get paid this much from your underlying asset, and you will get paid some extra from income or any other type of dividend. You will have to pay a little bit for the storage. So the final payment will be like this. For now, I mean, this is not really important. So if you don't want to deal with this thing, you can ignore D minus C because that's not the most important part here. So that's one possibility. So you may buy something in the underlying spot market. Alternatively, you may put your money into a bank, and if you do that, if you put in the exact same amount of money into a bank, you will receive with interest this amount. So that's how much you will receive in the future. Given these two possibilities, one simple argument would be that whether you put your money into bank or whether you put your money into the spot contract, you should get exactly the same amount in the end. And therefore, you may say that this amount should be more or less equal to this amount. However, we don't know this number. So from the ex ante current perspective, you may say expected value of this thing should be identical to the expected value of this thing. And therefore, we may write down expected value of this thing is the same thing because there's nothing is uncertain. And expected value of this part would be, let me write down here. So first you will say expected value of S capital T exponential D minus C capital T minus T must be identical to expected value of S small t exponential R capital T minus small t. So that's the first step. You will say expected value of one should be identical to the expected value of the other. However, there's no uncertain term here. So we can ignore expectation operator here and move everything to the right-hand side and say in equilibrium, expected value of the spot price must be something like this. So that's one thing you can say. Now, if you think about the argument here, this is rather different from the no arbitrage principle. First of all, when we apply no arbitrage principle, we didn't deal with any uncertain number. We didn't have to worry about S capital T, but here we do have S capital T here. So this is not about no arbitrage argument. You cannot get to this equation from no arbitrage argument. And what is the argument? Why did we say that these two should be identical? This is more rough argument. So the story is, if you're an investor, you have two choices. You could put your money like this, or you could put your money, use your money for this. If this is really your money, let's say you are thinking of putting your first $1 million either into banks, a bank for 6 months, or into some stock for 6 months. Which one would you prefer of the two? Stock investment or bank deposit? If you have $1 million now, what would you buy Tesla?
Go for a bank because it's risk-free.
Okay, so so you think the stock will give you higher price, but let's say here, depending on what you think this expected value of this number is. So what I wanted to say is that it really depends. It's not absolute. Some people may say this is better option because it's safer. Some people may say as long as expected value of S capital T is higher, they will go with this thing. So whether we can actually get to this thing is not really obvious. So the argument here is that if we ignore risk for now, then if nobody really cares about risk, then it's probably true that people don't really care which one to choose if they are not interested in risk. In that case, we will get to this equation. More generally, if we consider risk, which one would be higher if we consider risk? Left-hand side or right-hand side?
So the expected return will be higher at the stock investment.
Right. So if we consider risk, it's more likely that this side will be higher. So the expected value of the spot price must be greater than this number. So that's the next thing we will say that that's more likely. So if you consider the risk, then most likely the stock price or any other underlying asset price should go up faster than the right-hand side. Now, why did we start with this equation? Because, this part should look familiar to you, right? From the previous part. What is this? This one. When you see this, you should see immediately what this represents. The right-hand side.
Forward price.
Right, so this is the forward price, and we didn't talk about forward contract in this example, but the formula we derive includes a term that is identical to the forward price. So what this equation says in the end is that the expected spot price must be identical to the forward price if we ignore risk, according to equilibrium argument. If we do consider risk, most likely relationship is that expected spot price should be greater than the current forward price. Okay, so that's what we want to say here. So the next step is if we add risk, then as we just said, most likely possibility is that the expected spot price in the future should be higher than the putting money into the number associated with putting money in a bank. So that's most likely situation. Now, but theoretically, it doesn't have to be like that. If you think about stock, this is probably the case. But now, in general, if you think about many other underlying assets, perhaps gold, perhaps government security, perhaps some other security, we can't really say it like this because one example, among the stock, there is this inverse ETF. What inverse ETF does is it goes the opposite direction. If market is up, the price goes down. If market is down, price goes up. So if that's the underlying asset, we can't have this relationship because it actually goes in the opposite direction to any other stock prices. And therefore, depending on the underlying asset, we may actually have the opposite possibility, which is that the underlying position, spot position, has lower risk than putting money in a bank. Now, this is not easy to imagine because in conventional situation, this is indeed the case. But what we are really thinking of here is having a short position. So if a spot contract is like having a short position, then of course this thing should go in the opposite direction. Now, if that makes you satisfied, then that's good. If you want to think about it a little bit more formally, then we have to talk about what we mean by risk and why people may demand higher return from risky asset. Now, when the general discussion we can have about risk is we may start from this idea of marginal utility. So the story is that ST, let's say ST can have two different prices. ST may be high, so let's say 200, maybe low, say 100. So average is about 150 if the probability is 50-50. And alternatively, if you, well, I guess we don't need extra color. Now, is this good or bad compared to, so that's number one asset. Number two, from bank, let's say you get 150, 150, regardless. So now we are comparing asset number one, asset number two, and asking ourselves, do we like this one more than the other one? And that's the question. Which one would you prefer, number one or number two? You have two possibilities. You may have contract number one, which gives you either 200 or 100. Contract number two, which gives you 150 all the time. Which one is better for you? If this is not your total income, you have extra income, and this is only a small part of your income, then it depends on what happens to your other income. So if your other income is very low at this time and very high, if this is the situation, then the story will be rather different. So the situation is following. When your other income is very low, this particular asset gives you more money. When your other income is very high, this asset gives you less money. In this situation, again, which one do you prefer, number one or number two? Right, exactly. So the most people will prefer asset number one because it will make your consumption less extreme. Because you have more money when you really need, you have less money when you don't really need. The I mean, it sounds a bit silly, but somehow that seems to work. So I don't know whether it's the friend in need is friend indeed or something like that. So that's the story. You really need money in this situation. So that's you really value the payment at this period. You don't need money when your income is high, so you don't really care whether you get paid a lot or not. So this is our more formal idea of risk. So in this situation, we will say asset number one has negative risk because it actually helps your utility. And therefore, even though this is the safe asset, we will say asset number one is even safer than asset number two because that really helps you to reduce overall risk. If that's the case, we will have a relationship like this, the second possibility. It's just that most asset, it will be very hard to find asset like this. Most asset will move together with the overall income level. Most asset will pay more when income level is higher. Markets tend to go up altogether. And the most asset will pay less when income level is low. So it will be very, very hard in reality to find asset like this unless you're talking about some kind of inverse short position, things like that. So this, in reality, this will correspond mostly to some short position, some kind of inverse problems. So instead of talking about income, let's think about marginal utility. And as you may remember from economics class, marginal utility is high or low when income is high. So the marginal utility goes in the opposite direction to income. When income is high, marginal utility is low. When income is low, marginal utility is high. The reason is, of course, when you have a lot of money, you don't gain much from having extra $1. When you don't have any money at all, $1 may mean much to you. So marginal utility indicates how much you appreciate having one extra dollar, and that tends to be moved in the opposite direction to income. So instead of talking about income, let's think about marginal utility. For some asset, the price of the underlying asset may move in the same direction as the marginal utility. What it means is when you really need money, your investment gives you extra money. When you don't need money, your investment doesn't give you any money. So that's positive correlation. So when there is this positive correlation between marginal utility and asset price, we may consider this asset a valuable asset because it pays when you really need money. So positive correlation between marginal utility and the stock price is something good for you, which means that you appreciate having this asset without, even if there is no return from owning this asset. So the required return, whatever investors demand from this asset is low. People do not demand much for owning this asset. And if the expected return equals required return, in equilibrium should be more or less same thing. What people demand should be more or less what it offers. So in equilibrium, the expected return will be low. Low expected return means that the price of this asset will be high. Okay, so it's the same thing, low expected return or high price. So in the end, what we will say is that if there is such positive correlation, current price of this asset will be higher and the expected return will be lower. The opposite case, if the correlation is in the opposite direction, that is, when you really need money, the asset doesn't give you any money. When you don't need money, the asset gives you more money. So this is a bad correlation. For such asset, investors will demand high return because otherwise this asset is not useful. So in that case, expected return will be high and the current price will be low because people don't want to buy this asset. So that's how we will think about risk. So it's not just one-sided story. Depending on correlation, the risk can be negative. So back to what we said last time. Before that, any question about this? So back to this story. This is what we wanted to explain last time. Depending on when you think about risk, this relationship may break down. This relationship makes sense if people don't care about risk. If people care about risk, then as we just said, the current price as small t can be high or can be low. And or if you think about in terms of expected return, this expected value can be high or low. So when there is bad correlation, when the asset gives you money when you don't need, then this is the situation. That is, the return from this asset should be higher because it's risky. It doesn't give you any extra benefit. Opposite case, if the asset gives you more money when you really need money, then you don't need return from this asset because you have other benefit. And in that case, the expected return will be lower or the current spot price will be higher. So we may say either way. If you move S small t to the left-hand side, then what we have in the left-hand side is the expected return. If you move S small t on this side, then you can think in terms of the current price. So either way, you can think about current price, you can think about expected return. The answer should be exactly same, whatever way you think about it. Right. The first one is more usual situation. If you buy some financial assets, stock, bonds, whatever, this is the typical situation because the asset prices tend to move together with the overall income. So the stock prices tend to be higher when your own income level is higher. So there's risk, there's positive risk. In that case, the expected return should be higher. To say the same thing the other way, the current asset price should be lower. Okay, so this is typical situation, but we have to think about the other because in our discussion, long and short, we will consider both long and short. So if long side has risk, then short side must have negative risk. That's why we need to think about the other formula as well. Now we want to think about the relationship between current spot price, the expected spot price and something else, which is the future price. So how do we move from this slide to the next? Again, if you look at this side, we learned from the previous week that this should equal to, what should it equal to, this part? So this should equal to the forward price or future price. So let's just say forward. So this part is identical to forward price according to the theory we learned last week. So let's just replace this with forward price. We have this slide. So instead of talking about current spot price, once you replace that part with the current forward price, then we have these three equations again. So what we have here is, once again, three situations. If people don't care about risk, or if the underlying asset and the forward position doesn't have any risk, we must have this relationship. It says that expected spot price must equal current forward price. In a sense, this makes sense that when people get into forward contract, the forward price should be more or less same as what people expect to prevail in the stock market in the future. So this equation corresponds to that situation. However, if risk is involved, we have one of these two situations. So this is more conventional situation again. When the underlying asset is something like stock or bonds, then what we have there is that the current forward price is less than expected spot price in the future. If the risk is the opposite direction, then we may have the situation where current forward price is higher than the expected spot price in the future. And I changed the description slightly here. I changed the description as non-diversifiable risk, which is more conventional way to think about risk in finance. That is, volatility is not all of the volatility or variation is risk. We will distinguish between type of risk that people really care about and the type of risk that people don't care about. And the way we distinguish between these two is we imagine that investors have a portfolio of assets, not just single asset. So the investors will have perhaps many stocks, many bonds, other position in real estate or anything else. And if the variation in ST, capital T, can be canceled out by the variation in the rest of the portfolio, then that's something that the investor wouldn't really care about. So what matters is only the non-diversifiable component of the risk. Anyway, but then the intuition is exactly same. Certain risk is something that investors want to avoid. Certain risk or certain variation, investors actually like it. So the consequence can be the opposite. So what this equation says is, if you think about something like forward price or futures price on KOSPI 200, then if the forward price, or let's say futures price is $100, it doesn't mean that people expect KOSPI 200 to be near 100 in the future. In fact, people's expectation must be higher than the futures price. If you see that gold future price is 120, doesn't mean that people expect the spot gold price to be 120 in the future. They will probably expect higher amount than what you see from forward price or futures price. Okay, so what this is the most typical situation when the underlying asset is financial asset. Now let's talk about the risk one more time to just have better understanding of what's going on here. So simple situation is the following. Let's imagine you buy a forward contract. So you have long forward position. And from that perspective, you create some uncertain cash flow for the future. So you may wonder whether you have good risk or bad risk, whether you have positive risk or negative risk, the other way. So whether you have some risk that you need to worry about and whether you have something that you actually benefit from. Now, if there is no risk, that if you can ignore the risk, either because you don't care about risk or people don't care about risk or because there's no really risk, then our previous discussion suggests that the expected spot price in the future should be identical to the current forward price. And if we move the current price to the left-hand side, what this amount says is this is the difference between spot price at expiration minus forward price, current forward price. So when you have long position, this is your profit. Okay? So when you have a long position, if the spot price is high, you have profit. If spot price is low, you have loss. So in a sense, we may call this part the expected profit to you when you have a long forward position. So what this says is that if there's no risk, then your expected profit is zero. So when you create forward position, you don't expect to make any profit, which makes most sense because you didn't pay any money. And it makes sense that when you create some position, forward position, you don't make money on average. That's most natural situation in a sense. Otherwise, it would be too easy to make money. So that's the situation. That's what this equation says. That is, if you create forward position, you don't expect to make profit. Or if you create short forward position, you don't expect to make money, you don't expect to lose money. That's what this equation suggests. However, if there's risk, then we have different situation. That is, if there's risk, then the expected spot price is higher than the current forward price, which means that you, in fact, expect to make profit. So how does that make sense? So imagine you are thinking of buying gold futures, for example. If you create long gold futures position or long gold forward position, do you expect to make profit? Or do you expect to make loss? Or do you expect to not make any profit or loss? Which one is most realistic? Okay, so if you believe that creating or bearing risk should lead to some compensation, then yes, it makes sense that you expect to make profit. So that's the right interpretation of this relationship, but that may not be what you usually think about. Because what someone may think about when they think about forward position is this is a fair transaction. That is, you create a position, you don't expect to make profit, you don't expect to lose any money. So that's this situation. And what we are describing here is when you create long position, you expect to make money. Which means if you create short gold position, then what do you expect? So if you expect to make profit from a long position, what should be your expectation from a short position? Right. So but why would anyone want to create short position in gold? Now that will be a bit off from what we are discussing here. So we are now talking about risk. We are saying if you have long gold position, you have risk that you don't want. But if you have short gold position, you have the risk that you actually want to have. That's why we are going in the other way. So let me repeat why this is an interesting idea, because some people create long gold position, and some other people create short gold position. If you say people in the long side expect to make profit, then you should be able to say people in the short side expect to lose money. Then you may ask, why would these people want to take short position, create short position, knowing that their expected profit is minus, or they expect to lose money? And our answer to that is back to here. This is our answer. Some people really like to have this correlation, so they are willing to actually pay to have this correlation. Now, whether this makes sense or not, whether that sounds realistic or not, that really depends on the type of the underlying asset. For the gold, maybe it's not that intuitive. If you think about stock, so if this is some stock index futures, then again, those who create short position in stock index future should expect to lose money because people in the other side expect to make profit. And why would they want to create short position knowing that they will lose money on average? Again, that's possibly the type of risk that they actually want to create, perhaps because of their other position. So what I already said, so if you think about the forward position in stocks, then we usually think of stock as having risk that people want to avoid. So therefore, the most likely relationship between current forward price or futures price and expected spot price in the future is that current forward price will be lower than the expected spot price in the future because stocks have the risk that people want to avoid. Unless this stock is some inverse product. If it's inverse product, it will be the opposite. So if you buy S&P 500 inverse ETF, then of course it should be the opposite direction. Now, if the underlying asset is not financial asset, but rather something with a convenience yield, then we need to introduce one extra term of the convenience yield. So this was the equation that will be relevant here. And once you replace this part with forward price, then again, we can say that the forward price should be identical to the expected spot price in the future if risk is not involved. And depending on the direction of the risk, then we may have different situation. So what I just said is if you move part of this thing to the other side, then we may write this as ET, S capital T, E minus R. That's the present value of the cost of buying the underlying asset in the spot market sometime later, not now. And the other side is the cost of buying the same thing in the spot market right now. That's whatever is remaining here. So that's one interpretation we can provide. We are comparing again two things, buying something right now or buying something later. And for buying something later, for this part, what this part suggests is you deposit this amount, this money into bank, wait, and this money will grow to S capital T, and you pay this amount at time capital T to buy in the spot market at the time. And the cost of these two should be more or less same if we ignore risk. That's what we have here. And this argument doesn't depend on whether there is convenience yield or not. It's exactly the same argument if you can calculate convenience yield. Of course, if you cannot calculate convenience yield, then this formula may not help you too much. But if you can calculate convenience yield, then yes, you can do that. So for example, crude oil price. Now, crude oil is definitely a consumption asset, and therefore we cannot ignore the convenience yield. When you think about crude oil, you have to think about convenience yield. So what this equation suggests is that if you know the convenience yield, then you can more or less relate the current crude oil price to future crude oil price if you know the convenience yield. If you don't know the convenience yield, then this will not help you too much. All you can say is that if you drop this part, whatever number you have will be higher than what you have written down here. So all you can say is that without this convenience yield, then ST minus D plus C, capital T minus small t. This number is higher than this number, right? So it will be like this. So for crude oil, you can say that the current spot price is smaller than the present value of expected spot price after adjustment. But we don't know the difference exactly because we don't know the convenience yield. So that's what we will end up saying. But as for once we replace this whole thing with the forward price or futures price, then our previous discussion still applies. So if people can ignore the risk in crude oil, the most likely relationship between current forward price and expected spot price is that they are identical. If people want to avoid risk in the that exists in the long side of crude oil, this is the most likely pattern that we will see. If people actually like to have the risk of crude oil, then this is what's going to happen. Most likely, we are either in the first or second case, somewhere in between. The last one is very unlikely because crude oil price also tends to move together with other economic activity most of the time. Crude oil price tends to be, well, it's not true, but in usual time when economy is booming, crude oil price tends to be higher. So that's when the marginal utility is low. But of course, the crude oil price may move in some other direction depending on what is driving the crude oil price. Question? So this is my summary of what we have discussed for the last 2 weeks. I was very proud of this table for a while, but then wasn't sure whether this helps a lot. But anyway, if it makes sense to you, that's great. If not, you need to come up with some other way of summarizing what we discussed. So what I'm showing here is first, we talked about the relationship between current forward price and current spot price last week, applying no arbitrage argument. And that's more or less what I wrote there. We derived this relationship from the story that we are comparing 2 options. Number one, we buy the underlying asset in the forward market and we make deposit for the future payment. Number 2, we buy the underlying asset in the spot market and the cost of these 2 should be identical. From there, we derive this relationship. However, this relationship doesn't work for consumption asset because for consumption asset, convenience yield exists. If you don't, typically we cannot really calculate convenience yield, so it's just concept. So given that, all we can say is that given the convenience yield, if you exclude convenience yield and calculate this formula, then this one should be greater than the other side. That's all we can say. So the conclusion is for consumption asset, forward price is lower than what we calculated otherwise. So the relationship between forward price, current forward price and current spot price depends on whether the asset, underlying asset is investment asset or consumption asset. That is whether there's convenience yield or not. If there's no convenience yield, we have the exact formula relating current forward price to current spot price. If the underlying asset is consumption asset, we know which one is greater, but we don't know the exact relationship. So for financial asset, people can talk about precisely what the forward price should be if they know the spot price. Or the other way, if they know the forward price, they know what the spot price should be. And this relationship holds all the time in the actual market for investment asset. For consumption asset, we don't have such formula. So for example, if you think about crude oil forward, even if you know the spot price, you can't really tell the forward price of crude oil. Even if you know the forward price of crude oil, you can't tell what should be the spot price. So that doesn't work for consumption asset. this works only for the investment asset, but many of the forward contracts are mostly consumption asset. So we can use this thing to only financial products such as foreign exchange forward, stock index forward, bond forward. These things, for financial contract, financial underlying asset, we can use this equation. Otherwise, this doesn't really help in the actual market. Now, second, what we just talked about is a bit different thing. That is, we look at the relationship between forward price and the expected spot price. And our conclusion is most likely situation is we have to consider risk. And for typical financial contracts, the type of risk is the risk that people want to avoid. In that case, the long side should expect to make profit, which means the current forward price should be lower relative to expected spot price, so that they expect to make profit. So this is the most typical situation that you can imagine for financial contract. However, for the consumption asset, it's not necessarily obvious. When you buy oil, is it the risk that you want to take, or is it the risk that you want to avoid? For crude oil, it's more likely that we are mostly in this situation, but for other products, wheat, cattle, whatever wood, other precious stones, it's not obvious whether taking long will increase your risk or taking short will increase your risk. So for that, again, this doesn't help you too much in that sense. So that's what we discussed so far. Any question? So in a sense, we have more to say about the situation where the underlying asset is financial product, and we have less to say about the situation where the underlying asset is non-financial product. So for the financial, when the underlying asset is financial product, we can say the exact relationship between current forward price and current spot price. And we can also more or less determine what the expected spot price should be in relation to the current forward price.